All right. Well, thanks everyone for taking the time to join us today. If you know our group, you know we love that song. My name is Sam Hardy, and today you're going to be hearing from our CEO, Nick Stenger, here at Stenger Family Office, where for the past 42 years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Want to remind everyone, we will have time for questions at the end. So whether you came prepared with some, I know some people had sent some in prior to it, or something comes to mind throughout Nick's presentation, there's a Q&A button at the bottom of the screen that you'll be able to click, and you can type a question there that we'll see come through. And before I turn it over to Nick, just wanted to go over some of the past calls that he has made. So first ones, and this is from his weekly insights email that he sends out. So December 2nd, 2020, he wrote, "You don't invest in presidents." And since that point, the S&P is up 31%. Next, we've got the August 25th, 2021, China's tech crackdown article. Since that point, China is down 39%. The United States is up 7%. The next article he wrote was on October 15th, 2021. No, it's not transitory. And since that point, we've seen inflation climb 13%. Next is February 10th, 2022. We've got the big bond bubble. Since that point, you've seen 20-year U.S. Treasuries down 28%. Short-term Treasuries are currently up 8%. And then the final article, October 6th, 2022, stocks are cheap. Since that point, we've seen the S&P climb 28%. Nick, I'll pass it over to you.
Yeah. Thanks a lot, Sam. Can you hear me okay?
Can hear you fine.
All right, awesome. Well, thank you so much for being on, everyone. Thank you for taking the time to join us for our 2024 market outlook call. And it just feels like yesterday that we were all together for the 2023 outlook call. But here we are, quickly approaching Christmas time. I hope you've got some wonderful plans with your family and spend some good time with them and enjoy the holiday season. And, I would say out of this slide here that Sam just went through, going back to October 6th of 2022, the stocks are cheap. Out of all these calls that we've had to make, that last one has got to be the toughest. And if you remember the narrative back on October 6th of 2022, towards the fall and the end of last year, the narrative was just completely pessimistic, and the doom and gloomers, all the pundits that you watch on CNBC or Fox Business or all the different places that you go for your financial entertainment, were bearish. They were negative, and they said that the sky was falling, that the world would come to an end, and that you didn't want to own stocks. And we made the bold call. I know it sounds kind of obvious in hindsight, but we made the bold call at the time that stocks were cheap, and that turned out to be the correct advice. If you look at the past 2 years, the past 3 years, even going back, we're going to be going on 4 years now since COVID started. I'll never forget, it was my birthday in downtown Naperville. We were at Francesca's restaurant there, a nice little Italian spot. And it was March 1st, 2020. I believe that would have been 2020. And everybody was saying, "Oh yeah, this COVID thing, it's kind of interesting. Heard some initial news about it. It'll go away. It'll be 2 weeks to slow the spread." Well, that turned into 2 years to slow the spread, and here we are now. It's going to be 2024. If I told you back then in March of 2020 that we were going to pump $4 to $5 trillion into the U.S. economy, that we were going to shut off supply chains, we were going to try and reopen the economy, turn it on and off like a light switch, go back to normal, and then also raise interest rates from basically 0% in 2020 and 2021 to over 5% in 2023, and that the market would still be positive over that time frame, you would have probably called me nuts. You would have said, Nick, there's no way that stocks were going to be up given those facts. But the reality is that stocks are up. And I'll just point to one of the other articles that we wrote at the end of last year, December 8th of 2022, that the Fed isn't done yet. And nothing, and I'll tell you, just because we were in our due diligence meetings at this time, we were debating what we wanted to do with portfolios just a few weeks prior to this article coming out. There was a real debate between what the Fed was going to do. And there was a real debate of, is the Fed going to raise to 4% or 5%? Because of that, do we want to be in long-term bonds? Do we want to even own stocks? And the strangest thing that happened was that despite having interest rates go up, despite having the Fed push us basically into what a lot of people would say is almost over the cliff, stocks were still up. Those two things are tough to square together. Stocks being up and the Fed being aggressive. But I think if you go back to what we had talked about, and you remember that phrase I kept throwing out there, marching through the wilderness, what was I making a reference to? Well, I was making a reference to the Israelites wandering around in the wilderness. And remember, they wandered around in the wilderness. They came out of slavery in Egypt and were wandering around the wilderness, and they were in it for 40 long years. If you remember back to your Bible school classes, you'll remember about the Israelites. And man, what a long time to be in the wilderness. Now, it wasn't as bad as they had it during Egypt and being under the control and the slavery, but it certainly wasn't the promised land. And so that was what I was trying to draw an analogy to, was that we were in this weird zone in the market where we weren't quite in the promised land yet. We weren't in this abyss either, where things were going to completely fall apart, but we were sort of stuck in no man's land. And if you look at this chart of the S&P 500 now, going back 2 years to November and December of 2021, and you look at where the S&P 500 index started at 4614, today we're basically break even when you don't include dividends. And so this truly has, as we have called it, a wilderness time frame. And it's not that we've ripped back to record, melt your face off, brand new all-time highs. And many of you have expressed this, Nick, my statement, I still haven't quite hit that all-time record high I saw in 2021. That's correct. We're slowly inching our way back there, but we haven't completely fallen apart. And I think that's what the bears got wrong at the end of last year. All the bearish pundits, all the pouting pundits of pessimism, as Brian Westbury at First Trust calls them, where all they do is go on CNBC and say the sky is falling, the world's coming to an end, it's time to build a bunker in your backyard, fill it with canned food and gold and all the rest of it. Well, the thing that they missed, in my opinion, is that the market is a forward-looking indicator. And if you have heard the show that we do every week, if you've listened to some of the presentations, if you came to Investor Day this past year, you've heard me say this basically to the point where you're probably sick of it now, but that it's so important for investors to understand. Stocks discount the future. And so what that means is that even if there's going to be bad news in 6 months from now or 12 months from now, the market doesn't wait 6 months or 12 months to trade lower. It trades lower today. And because the United States, we have the best economy on earth, we have the most free financial markets, the most liquid markets where everything's priced in basically instantaneously. Because of that, stocks go down in the short run because of bad things that are expected to happen 6 months from now, 9 months from now, 12 months from now. The same happens in reverse. If there's something good that's going to happen, or the market's positive, or there's some certainty that's built into pricing, then what happens is the market rallies well in advance. And so all these people who were saying on CNBC or Fox Business, oh yeah, I'm going to wait until things get better to get invested. Well, what happened? Well, they missed out on this massive rally. They missed out on stocks basically wander through through the wilderness. And again, they didn't completely fall apart. They haven't shot the lights out, but they certainly haven't been this doom and gloom scenario that people said. So despite the fact that the Fed started raising rates in 2022 and then got to a 3% federal funds rate, which we found out was just the start, right before November of 2022, and now we're at 5%. Despite all of that, what is the market saying today? Well, the market's saying today that we expect lower rates to be processed in the future. Now, does that happen in 2024 next year? I actually don't necessarily agree with that. I don't know. The big debate here is whether or not Powell wants to be the next Arthur Burns, who was the Fed chair in the 70s, who cut rates way too prematurely, and that gave rise to the runaway inflation in the 80s under Paul Volcker. Some people think that Powell wants to be known as Paul Volcker, who was hated at the time. He was detested in the 80s. But looking back now, a lot of economists say Paul Volcker should be regarded as one of the best Fed chairs in history. Why? Because he killed, or so they say, he killed inflation by raising rates to, do you remember the 20% rates, the 21, 22% mortgages, all the rest of it? Well, at the time, nobody liked him for it. Now people say Volcker was a hero. And so I actually tend to agree in a way that Powell wants to be very careful how he's perceived long-term and how history looks back on him. And so it's possible that he keeps rates higher for longer. That's the term that you've heard. And by the way, higher doesn't mean they're at 5%. Maybe they're at 4%. By the way, for 30 years, average federal funds rate's been about 3 to 4%. So that's not out of the ordinary. And we're going to get into my projections for the S&P for next year. But before we do, I'll just make one comment. I hope I don't give away too much here, but I think people are overly bearish for next year. I think even if we see the Fed keep rates a little bit higher than we expected, I still expect stocks to do well. So let's keep going. I want to show you a couple more data points here. This is how we did in 2023 this year, and then comparatively to the past 10 years, these are annualized returns on the right. The best sectors, no surprise, in 2023. And the reason I say no surprise, we'll talk about that. But if you look at the top sectors, we've got technology, which returned 51% this year in 2023. Consumer discretionary, those are your stocks like Tesla, Amazon, a lot of the spending you don't necessarily have to do, but you want to do. Then we've got industrials at 12%, companies like John Deere. We've got financials, of course, pretty self-explanatory. A lot of the banks would be in there. A lot of Berkshire Hathaway would be in there, companies like that. We've got materials, companies like Sherwin-Williams. We've got real estate. We've got healthcare, energy, and consumer staples. If you look at the trade this year in 2023, what happened? And I'll go back to something I said a second ago, not a huge surprise. Well, if you reverse this and look at 2022, all the sectors at the top here were at the bottom last year. So technology just got absolutely destroyed in 2023. Consumer discretionary, people said we'd never spend any money ever again. Well, they got destroyed last year. Industrials got destroyed. There'd be no growth. Financials basically tread water. Real estate basically was even. But energy did very well. Consumer staples did well. Why? Because those are the doomsday prepping stocks. Your companies like Exxon, Chevron, Conoco, companies like Campbell's Soup. People are going to be buying more soup as they fill up their bunker, I guess. But the point of this is 2023's return is really not that much of a surprise because the stuff at the top this year got hit so badly in 2022. Remember, the market is a forward-looking indicator of what's to come. So if you compare that to the 10-year numbers, look at what's at the top consistently. Technology, number one. We've got consumer discretionary. We've got healthcare up there. What's at the bottom? Energy. Okay. Companies like Exxon, Chevron, Conoco. We've got consumer staples somewhere close to the bottom. We've got real estate pretty close to the bottom. And the reason for that is because in the long run, companies are valued on growth prospects. So yes, in the short term, a value stock can be a good trade because it can be a hedge against inflation. But over the long run, what are investors valuing companies on? Well, they're valuing their companies based on long-term growth. Technology companies have grown the fastest. And just remember, the S&P 500 is a meritocracy. What does that mean? Well, the top companies, because it's a cap-weighted index, it's ranked by market cap, the largest companies in the S&P 500 go to the top. The bottom companies go to the bottom. And eventually, if they don't perform for long enough, the S&P 500 index actually kicks them out of the index. And so what you're left with the S&P 500 is just a whole lot of great companies. And not all of them are perfect. We put a different spin on it. In fact, we only want to own usually the top 50, sometimes 100, depending on the portfolio you're in with our group. But the point is the biggest get bigger. The top companies continue to outperform and drive return over the long run. All these people shouting from the rooftops this year, oh, it's only 7 stocks driving the market. It's the Magnificent Seven. It's the Great Eight, whatever you want to call it. I think Sam came up with a different name the other day. But regardless, that's just not true. The top companies are driving the market forward because they're the best. That shouldn't be something that we're upset about. That's just the reality of being an investor. So the lifeblood of a bull market is that we have this thing called sector rotation happen, which means the companies that are underperforming right now eventually start to lead the charge. And I'm not saying that energy is going to be the top sector for next year. I'm not saying consumer staples will be the top sector. I'm just saying you've already started to see some of these stocks where they were down 15 or 20% at the beginning of the summer. Now they're actually coming back up, and they're only down 3 or 4%. What that tells you is that most of the market is catching up with big tech. That's a good thing. That tells me that we're in the middle of a bull market that could last for years to come. Let's talk a little bit about CPI. You've been watching this CPI report today that came out. You're going to see tomorrow the Fed will talk about interest rates. I got to be a little careful since this is a recorded show. So I guess you can call me out on this later if I get it wrong. But my guess would be that we don't have any more rate hikes. Again, I'm a little cautious on believing there's going to be rate cuts. But I think the Fed's going to say, let's see how our rate hikes have already affected CPI. What goes into CPI? CPI is just the prices that you and I pay. If you look at companies, there's an index called PPI. So if you're a producer, that's the producer price index. If you're a consumer like you and I are, we're the consumer price index. Well, most of consumer prices are made up of shelter, which is housing, food, and energy. And so if you kind of break down these costs and you look at what's been driving CPI so much the past couple of years, it's this number right here. It's rents. If you look at rents across the United States, rents are at a record all-time high. And in fact, a lot of multifamily developers, real estate developers, jumped on this bandwagon. They said rents are going to go higher for longer. We're going to fix our mortgages at 2 or 3 or 4%, and we're never going to look back. And that's exactly what they did. If you go back to January of 2020, before this all started, and you look ahead till today, we are up dramatically, about 30%. Some of these numbers, if you go even deeper into the detail, are up about 40, 45%. Remember, when the Fed pumped $4.5 trillion of stimulus into the economy, what happened is we devalued our currency by about 40%. Think about what that means for real estate holders. Well, if you've got a property that you're renting out and you're a landlord, your entire economic mix is based off of something called a cap rate. So you can't make money unless you've set your cap rate or your rental rate divided by what the property's worth high enough to pay all your expenses. And so at the time where all of your expenses are going up, your maintenance costs are rising, your taxes are going up, your insurance costs are through the roof, what do you have to do to your renters? Well, you have to raise your rent to be able to cover the increased costs of basically doing business. And so what's happened is because we've printed so much money into the economy, we've devalued the dollar so seriously, so significantly the past 3 years, it's made asset values go up. But for people that didn't own these assets, it's been killer because their rents, their cap rates on these assets have gone through the roof and they don't have any equity in the property. So a lot of doom and gloomers have looked at this number at rents, because this is such a big piece of especially millennial budgets and all the rest of it. They've looked at these numbers and said, this is what's going to push us off a cliff. We have rents just too high. It's going to be a big problem. And we said, well, look at the other side of this, not just rents, but mortgage payments. Remember what everybody did, including myself, including Sam, including Bon Ruth, my business partner, including a couple other people on our team. I think Julia, a couple of our other teammates all did this. What did we do? We bought houses in 2019, 2020, and 2021. Or if we had a house before that, what do we do with our mortgages? We refinanced. And so we went from maybe a 4 or a 5% interest rate down to 3 or 2.5%. Many of you have children who have done this, grandchildren who have done this now, where they have refinanced to rock bottom mortgage rates. This number that you're seeing on this chart here is simply mortgage payments divided by how much disposable personal income we have. And so if you take what you pay in mortgage divided by your income, we are actually near rock bottom levels that we have not seen since the early 80s. Because of that, we have not, again, fallen off a cliff. Consumer spending has not fallen off a cliff. And that's going to be our next chart here, not to give too much away, but consumer spending is still up because we are spending less money on our mortgages and we're putting that money back into the economy, and we're buying Teslas, we're buying Traegers, we're buying Pelotons. All of that's kind of changing now, and we're going back to travel. People are going on cruises, and TSA just published their, I think it was their Thanksgiving numbers, the best numbers they've ever had. If you remember back to 2020 and COVID era, people said we'd never go back to normal. We'd be in a new normal. Well, that's just not true. We're back at record travel. We're back at record cruises. People are going to casinos, whatever it is that people like to do. They're taking that money that they used to spend on their mortgage and they're spending it on all this discretionary spend. The other thing I just want to point to, and I see the doom and gloomers say, Nick, we're going to end up in recession, and maybe it's not because of the mortgage payments, maybe it's not because of the rents, but it's because of rising energy prices that are just going through the roof, and it's crushing middle income families. That's 100% true, but it was true in 2022. It's coming down, and it's not as true in 2023 going into 2024. And in fact, one thing that I would show you here is that it's been very rare in US history to have spiking energy prices and not have a serious recession. In fact, in almost every recession we've ever had, we've had rising energy prices. Well, look what happened in the summer of 2022. We had a record high spike in energy prices and gas and oil and all the rest of it. In 2022, that summer, we had 2 consecutive quarters of declining real GDP. Now, if you've ever taken an economics course, you know that that means we're officially in recession. You have 2 declining quarters of consecutive real GDP. That means the economy didn't grow. It actually contracted 2 quarters in a row. What does that mean? We're in recession. Well, guess who didn't say we're in recession? The National Bureau of Economic Research, which is supposed to publish that we were in a recession. Now, some people say it's politically motivated. I'm not going to get into that. I'm not here to make a political statement. All I'm telling you is that if I think back to my economics, my Econ 101 course, that a recession is 2 declining quarters of GDP, and I didn't see a recession called officially by the government bodies that call recessions, I would say that there's a lot of people on Wall Street who missed the fact that we had a recession last year. Because we had a recession last year, these cycles in the economy lasts for 10 years, sometimes 8 years. Think about 08 and 09. We came out of 08 and 09. We made record highs by 2011. We were back into a bull market. We didn't have a recession until this last little gray bar on the screen, 2020. So these cycles don't happen every 3 to 4 years. Typically, they happen about every 8 to 10. And because of that, I think there's a good chance with declining energy prices today that we may not have a true recession, or if we do have a recession, it will be a blip on the radar. It'll be a short-lived recession. And all of these doom and gloom pundits that I keep talking about thought that 2023 would be doom and gloom. They think 2024 is going to be doom and gloom because they're waiting for a recession that already happened. So don't be part of that group of people. You got to get the data. You got to know what's going on behind the scenes. I actually believe, and I continue to believe, that a lot of these bearish people are looking for doom and gloom that's just not going to happen. And again, it's consumer spending driving the charge. The consumer is 70% of the economy, and that's been positive. Could you see a drop off a little bit here or there? Sure. We see little dips from time to time. And you know how the media is going to spin it. They're going to say the world's coming to an end, but we just have not seen a slowdown. I'll just share an anecdote with you. I've been downtown now a couple times to get dinner with friends, dinner with clients. We just had our Christmas party for our team downtown Chicago, and it was packed. I mean, you could not get in anywhere. You had to have reservations well in advance. I asked the manager of the restaurant, I said, how's business? He said, never been better. We've never had a year like 2023. I was just a couple weeks ago in Katy, Texas, a suburb of Houston. We're having dinner on a Tuesday night. Nice restaurant. Parking lot was packed. I couldn't even find a park. There was one parking spot left in the whole parking lot, Katy, Texas, on a Tuesday night. So who are you going to believe, the media or your lying eyes? That's what I keep going back to. And this is what we try to show you with our show Bullish, is that the real economy, you and I driving the market forward, is still strong. There's still a lot to be positive and optimistic on. So we're going to wrap up here in the next couple of slides. We'll take some questions as well if you have them. But I want to go back to something that Benjamin Graham said. If you know that name, or if you don't know that name, that is Warren Buffett's former mentor, he basically wrote the book on stock valuations. Munger's one of Charlie Munger's close mentors as well. And you know, Charlie Munger from Berkshire Hathaway just passed away. Just an absolute legend in the business. But one of the things that Ben Graham said is that in the short term, the stock market is a voting machine. What does that mean? Well, in the short run, stocks are volatile because the market prices in information so quickly, and it's trying to find out what is a company worth on a day-to-day basis. Today, it's worth 10 billion. Tomorrow, it's worth 9.9. The next week, it's worth 11 billion. Oh, we overshot. Now it's worth 8 billion. That's how the market works in a short run, in the short run. There's always two components that go into calculating a stock's price. So when you see that Apple, I haven't looked at Apple this morning, but I believe it's right around 200 a share, somewhere in there. You think, Nick, why is Apple worth 200 a share? Well, simply it's worth 200 a share because the market is taking its forward earnings. So the money that we think they're going to make in income next year, usually about 12 months out, multiplies it by some sort of valuation metric. What are those earnings worth in the future? If you do this to the entire S&P 500 index, what you'll find is that earnings estimates have been very strong for this year. They're going to be very strong for next year, it looks like. And this isn't just my data. This is Yardeni Research, which has been the leader on the cutting edge of this for years now, charting out S&P earnings, 2025 earnings. I know that sounds like a really long ways off, but remember at the end of 2023, this year, we're already going to be trading the market on 2024's earnings. At the end of next year, we'll be trading on 2025's earnings. And so all of these numbers look very positive. In fact, they look more positive than anybody could have ever imagined. Will we have some pullback? Sure. Will we have some downside? Sure. Will we have a correction? Absolutely. Okay. But if you look at the valuation on the stock market based off of 2024 earnings now, the S&P is trading right around 19 times earnings. That's not that crazy. That's really not that bad. And by the way, I would argue that the biggest companies can trade a lot higher for that for a lot longer because they're much better managed than most of the index was. And so if you look at Apple, you look at NVIDIA, you look at Google, you look at all these different companies that are leading the AI charge or leading the technological revolution and all the different transformations that are happening in our world today, which are really exciting. Companies like Tesla, Elon Musk, who's basically our generation's Edison. Okay, I mean, the guy's just fascinating. You could love him or hate him politically, but you got to at least look at what he's doing tech-wise. It's just incredible what's going on from an innovation standpoint. You could value those companies at 30 times earnings. Why? Because those companies are going to grow and grow and grow to the tune of 20, 30% growth rates the next couple of years. So I would argue that in the short run today, the S&P is not dramatically undervalued. And when I made that call in October 2022, and then the market ripped almost 30%, since then, the market was dramatically undervalued. I wrote an article specifically, stocks are cheap, right? And then you saw my one a couple of weeks ago, bye bye baby, everybody's bearish. So telling you, hey, stocks are really cheap. Well, today at 4,600 points on the S&P, we're not dramatically undervalued. We're not undervalued like we were last year, but we are certainly, in my opinion, not overvalued. In fact, we could reach overvalued territory for a while, and that still would not be a reason to sell stocks. The reason why is because if you look at the late 90s, we actually had 5 or 6 consistent years leading up to 1999 with the tech bubble, where valuations, stock prices went up so high, but earnings just did not go up nearly as much as stock prices. In fact, today, we don't have that problem at all. Obviously, with some companies, some of these companies where, like Peloton was, basically getting valued on the fact that they were going to sell you 3 Pelotons, which we said was never going to happen. We said, watch out, be careful. There's some high octane stuff in the market. But if you look at the broad S&P today, stocks are still growing their earnings and going up at the rate of their valuations. So I just do not see the doom and gloom ahead, especially in the long run. And this is the other side of that same coin that Ben Graham talked about. In the short run, we're a voting machine. In the long run, stocks are a weighing machine. What are they weighing? Well, they're weighing the merits of management. How good is the CEO? How good is the management team? How good is how good are the business prospects? How good is the product they're making? Are they growing their profits? Are they paying dividends? And over time, when you're buying great companies for the right price, you will see your portfolio rise over the long run. Now, you're not going to just completely see no dips. You're not going to just have a straight line up without any corrections. But what you will have is consistent wealth creation over time. And I just go back to Charlie Munger. Before Charlie met Warren, Warren was basically, the saying was buying cigar butt companies. He was buying these really deep value companies that were super depressed. Their assets had gone way down, and he was buying them hoping to make basically a quick trade. It wasn't until Warren met Charlie that Charlie basically said, look, Warren, we've got to buy really good companies. And if we pay a little bit more than we typically would have liked for their earnings, no big deal. We're going to make it back up. These are great companies. And without Charlie's advice to do that, they would not have bought Coca-Cola. They would not have bought American Express, 2 of the most iconic brands this country's ever seen. And they wouldn't have even bought a company called Apple, because Apple had a high price to earnings ratio. Well, look at what Apple's done the past 5 years. It's been probably our number 1 or number 2 best performer in the portfolio. So the point is that if you buy good companies and hold them for the long run, you will make it through the wilderness. So let's keep moving on here. I just want to get into briefly one of the points that I would make about the presidential cycle. There was a question that came in advance about this, but I'll just allude to this now. And that's the fact that in the 4th year of the presidential election cycle, which would be next year, we continue to see this pattern where stocks produce positive returns. In fact, in that 4th year, which would be 2024 of the cycle, you've got a 75% chance that stocks are up. Well, look at the previous 3 years. This year, we're in year 3 of the cycle. The average return is 13.5%. Again, no surprise, stocks are up in 2023. Look at last year, year 2 of the cycle. Remember, that's the midterm year. Stocks are only up 3.3%, and they're only up about 54% of the time. So again, no surprise we had a down year in 2022. So again, this is not to say we're not going to have any bumps next year, but I think there's a good chance that next year isn't quite as strong as 2023, but I still think it's going to be a positive year going into the election cycle. Okay, here's our forecast. This is what you've all been waiting for next year. And again, we go back to that equation, earnings times price. What's the right price to put on the S&P? Well, I'd say in the most bullish case, where we have rate cuts to the tune of 250 to 300 basis points, and earnings are still very positive, higher than expectations, I think we could trade the S&P at 5,400 points. In the worst of scenarios, I think if earnings are cut, earnings estimates aren't as good as we think, and maybe even valuations go down, potentially we see the S&P trade right around where it is today. So just not a whole lot of any growth. But my base case, and where I think we're going to end up at the end of next year, is right around the 5,200 point zone. And you think to yourself, Nick, how is there any way that we're going to trade the S&P up to 5,200 points and still produce the profits that we produced this year, plus grow them with all the doom and gloom out there, with all the inflation? Well, I hate to say this because this affects families, this affects people, affects our clients. But the way that corporate America next year, in my opinion, is going to protect their profit margins and they're going to save their earnings is through layoffs. I wrote an article in April of this year called Layoffs Are Coming, and watch out, just prepare for a rainy day. Make sure you have some cash. Make sure you've got your game plan in place in case you're affected by layoffs. I think next year will be the year of this. And I'm not saying every Fortune 500 company, I'm not saying every S&P company, but what I am talking about is there's a lot of small caps out there. There's a lot of mid caps that just have not managed properly through the past couple of years. They've overhired, they've got too much inventory on their balance sheets, they need to start saving some money, and the easiest lever to pull is labor, unfortunately. But that's where I think you're going to see profit growth come next year. Here's the price targets from the rest of the firms. You can take a look at that. We've got a wide range. All the doom and gloomers and the bears are at the top there. JP Morgan and Morgan, and actually Stifel's usually been pretty much on the money. You got Brian Belsky over here at BMO Harris. He's been right on the money. He nailed the call in 2023. Fundstrat, that's Tom Lee. He's been right on the money. But what you're going to see is the people with the lowest estimates here are going to be the face of CNBC next year. They're going to be on, they're going to be on closing bell every day, opening bell. They're going to be writing articles, getting their name in lights, maybe even do a Netflix special or a book tour. And you're going to be thinking, wow, these guys are really smart. Then you're going to see all these other guys, or maybe not see them at all, from BMO Harris and Fundstrat and Deutsche Bank. And the media will never cover them because there's just nothing interesting to talk about. If they put on Brian Belsky from BMO Harris and they say, Brian, what do you think the economy is going to do, next year? He's going to say, well, I think it's going to be just fine. And he's not going to say anything that's kind of has a sizzle to it. So this is a saying that we like to say around the office, that bears are smart, or at least sound smart, but bulls make you money. So you're going to see all these bearish people next year. They're going to sound really smart. They're going to have the CFAs and the MIT PhDs and all that other, all the credentials and all that stuff. But at the end of the day, if you look at their track records, if you look at what they've really produced for clients, you would have lost money for 10 years. They would have gotten it right 1 out of 10 years. But the other 9, you would have been like, well, what are we doing? We've been sitting in cash in the best bull market that we've ever had. And so the reality is that bulls make you money because optimists do better in stocks. Any given year, you've got about a 56% chance year to year that the stock market's up. Going into the presidential election year, the 4th year, you got a 75% chance the market's up. I'll throw one more stat at you here. You've got a higher chance that the market's up 20% or more than having it be negative for the year. So using that data, what I would tell you is follow the portfolio managers. We are portfolio managers. We have to produce a track record. We wouldn't have any clients if for the past 10 years we had sat in cash and said, don't wait, the doom and gloom is coming. We're preparing, we're ready for a rainy day. We wouldn't have any clients. We'd be out of a job, okay? So the portfolio managers, all the people who have been optimists end up doing just fine and produce returns. The people who have been bearish, the strategists, the pundits, all the people that get on TV, nobody really checks into their track record. Why? Because they don't manage any money. They don't have a single dollar to manage that they have to produce a track record on. So they could say whatever they want and fade into the darkness, and nobody will call them out for it, except for us. We will call them out once in a while, not to make fun of them, but just to say, hey, if you're going to be wrong for 9 years and only be right for one, that is risky. That is dangerous for clients. You have to be an optimist. And I'll just throw one other saying in there that goes along with this one, and that's that pigs get slaughtered. And what does that mean? Not to be too graphic, but what that means is basically that yes, bulls make money, but we don't have to be overly aggressive. We do not have to be buying high octane tech. You've seen this now, like Warren Buffett said, when the tide goes out, you find out who's swimming naked. Well, when interest rates go up to 5% like they are today, we're finding out a whole lot of people who took on a bunch of leverage in 2021, 2022 are swimming naked. We do not have to be part of that as investors. We don't have to get greedy, but we just have to be on a balanced long-term plan. So that's about it for me on my monologuing here. Thank you for sticking with us. And Sam, I'll turn it over to you if there's any questions.
Yeah, we had one come in, and remember, if there's anything that comes to mind that you'd like to ask, you've got the Q&A button at the bottom of the screen that you can click and type something in there. And then I know we had some sent in before. So the question that came in was about geopolitical conflicts. Nick, think, Russia, Ukraine. We've got Israel, Palestine, potentially China, Taiwan. What are these going to do? How are they going to affect markets?
Yeah, good question. I do have some current concerns in the short run that the geopolitical risks out there, and there's always geopolitical risks, but it seems like it's a little bit more heightened today, would be reasons that we'd see sell-offs in the short term. Those are always buying opportunities. And again, this is not something that we want to root for. This is not something that we like by any stretch of the imagination. But if you just go back to basics of central banking 101, a lot of these conflicts have basically been fueled by central banks for 300, 400 years of global history. And so I actually tend to believe that when you have these conflicts, they serve as stimulus for the economy. There's a reason why when you have somebody in power, like a dictator or a president, perhaps, that's not doing so well in the polls, they would want to start a conflict to basically distract from what's going on at home. And so, unfortunately, these things do serve as stimulus. It's really sad to say, but it's not a reason that I would want to panic and get off my long-term plan.
All right, we had another one come in as well about the rising national debt, deflating the dollar. What kind of issues do you foresee coming from that?
Yeah, great question. So, right now, and I think that question gets into two things. It's talking about inflation, and then it's talking about debt. Let's talk about debt first. Debt, I believe, is going to be a long-term problem, not a short-term problem. And what I mean by that is, remember, the other side of the balance sheet is the balance sheet of a company or a country doesn't just operate in a vacuum. So it's not just, oh, we've got all this debt over here. We've got the other side of the balance sheet, which is assets. And so, yes, U.S. debt is at an all-time high. Our national debt's never been higher, but so have our assets. Our assets have never been higher. The bigger question is, can you pay for that debt? Can you service the debt with your income? And that's what you find out when you go to apply for a mortgage. And it doesn't matter how much in assets you have. What does the mortgage officer want to know? What's your income? Can you pay for the mortgage every month? And so that's really what we want to look at with the U.S. Right now, we still produce the most GDP of anywhere on earth. I don't see that changing anytime soon. And so right now, and I say right now, for the foreseeable 4, 5, 6 years, we can still service the debt with our income. At some point in time, the debt could get to the point where we are in such a bad place from a servicing standpoint that Congress will have to act, and we will have to be forced to pay our debt off. And you think, Nick, that's ridiculous. There's no way. Well, it's happened It's happened many, many times in the past. We did this in the 70s where we were coming off the LBJ years. We were coming off of the print and spend, even the FDR years. We still had some hangover left in the 70s and the 80s. And what did we do? Well, we paid off the debt, we cut spending, cut the size of government. You're seeing this in Argentina right now with the new president down there, Javier Milei. And what is he saying? Well, the only way we're going to solve the inflation problem is if we start paying down the debt. So right now we're okay, but eventually Congress will have to act. They will be forced to act. It'll get so bad to the point where it's not going to push us off a cliff. We're still the best place on earth to invest. But I do believe at some point we will be forced to act. But it's not, again, it's not a reason to panic out of stocks. Stocks in a lot of companies, in a lot of cases, have more cash on their balance sheet than most banks have. And so, I wouldn't say exactly that large tech companies are the new banks, but they've got better balance sheets than a lot of banks out there. So this is not something that I would, again, be worried about right now. But again, in the future, it's something to be watching.
Okay, and then there was a follow-up to that one as well. As far as precious metals go and people saying they're a good hedge against inflation, what are your thoughts on that?
Yeah, the biggest problem with gold, and yes, it is true. The past 5 years, gold has actually produced pretty good results. But the problem with buying precious metals is it's always a trade. And in the question, I see it there on the screen. This person included the word hedge against inflation. That's exactly correct. Every time you buy precious metals, they are a hedge. They're not an investment. And so when you start buying gold and silver and you see all these commercials on TV, I get my gold from Rosin Capital and all the rest of it. Well, I think the reality is you have to decide, am I going to invest or am I going to speculate? Once you start getting into precious metals, you buy gold and silver, you buy these coins and all the rest of it, you get into the world of speculation and you get away from the world of investing. And so I think long term, yes, the past 5 years have been okay, but I think long term, equities will continue to beat gold as the best inflation hedge. And Dr. Siegel's covered that, stocks for the long run. Some of you have seen him live with us before, but I think long-term stocks will continue to beat precious metals.
All right, and then I know we had one come in about some major trades by Buffett recently. I'm wanted to ask which one they're referencing specifically, because I know they're sitting on some cash and we've talked Apple. So I'll wait to hear on that one and go to maybe one that we had come in beforehand. And getting into some of these things that we should be paying attention to and what they might mean if we were to see a major market correction. And this was coming from one of our clients who's already retired. So, they want to make sure that they're extra, smart about what they're doing. What are you doing to protect clients in that situation from a major downturn?
Yeah, great question. So this is what gets into my last point about bulls make you money, but pigs get slaughtered. And it does get into the fact that you have to have careful risk management. So when you are running a portfolio for somebody who's retired, it looks a lot different than running a portfolio for somebody that's my age or somebody's mid-career or even 55 or 60. Because quite frankly, at 60 years old, you still have maybe 20, 30 years to live. That's a long time horizon. But when we start getting into the heart of retirement, so 75 or 80 or even 85 years old, what you want to do, and this is our opinion, is to have a goals-based approach, not risk-based. Risk-based says, oh, we're gonna have a 60-40 portfolio or a 70-30. That's fine. You may end up there eventually, but that's the wrong starting point. Really, where you want to start is, what are my goals? Well, first of all, I can't run out of money while I'm retired. I've got some living expenses that I've got to take out every year. I've got maybe a car purchase or a home or maybe some major renovations at the house or a wedding I have to pay for, you name it. There's a million different goals. And once you've planned for those goals and you say, okay, I spend 100,000 a year, you can now multiply 100,000 a year by, let's say, 5 years and come up with a pretty nice chunk, about $500,000, for example, of living expenses set aside in short-term treasuries. So what do we do to protect people? Well, we don't want to be reactionary. We don't want to be responding to market corrections and saying, oh, we're going to get in and get out and there's doom and gloom on the horizon and all that stuff. Instead, what we want to do is we want to say, let's have a proactive plan. Let's get ahead of the correction because we know there's a correction coming at some point, and just make sure we've got enough set aside in short-term treasuries. We're not risking clients' safe money. And that's, I think, the big mistake a lot of people made last year too, where they bought these long-term bonds. By the way, that's why SVB went under. That's why Silicon Valley, First Republic, a couple of these other banks, that's why they went under, is because they were buying these long-term bonds with what should have been their safe money. We have done the opposite of that, and right or wrong, maybe interest rates go down and we would have wished we'd have had a little bit more duration in the portfolio. But I still think long run, you just got to go back to your goals-based plan. I do not, under any circumstances, want to risk client short-term money. So once you get your short-term money and your short-term goals figured out, then we take everything else and we buy high-quality U.S. blue chip companies, hold them for the long run. And, for 42 years, next year will be 43 for the Stenger family. That has worked out really well.
Okay. And then got a response. So on the Buffett question, selling off some of his holdings, to the tune of billions of dollars of his Berkshire holdings.
Yeah, I maybe I missed that news. I didn't see that. I know he trimmed back on some of his maybe you can look it up here, Sam, while we're talking, but he's sold off a few of the I think about 5% of a company. I'm just blanking on the name off the top of my head.
I know he
No,
reduced HP some.
that's what it was. HP. Yep, HP. So no, Buffett does this all the time. They buy stocks, they sell stocks, they take profits. And you got to remember, Buffett's kind of operating as a mutual fund at this point. So, there are some trades where he'll buy something and then it makes us be a little bit more interested in it too. Great example of that was Lennar, the home builder. And they added a significant position this past summer to Lennar. We like the thesis. We like the idea too. We don't always do this, but it made sense and it really turned out pretty well. We did the same thing. But just because he's taking some profit, you got to remember, he's had these stocks now, these companies for 30, 40, 50 years in some cases. Just because he's taken some profit doesn't mean the world's coming to an end either.
Yeah, and I know some of what I've seen with him too, and not to steal any thunder here in answering question, but he is trying to give away a majority of his wealth throughout his life. So I know part of what he does as well is he might sell some of his holdings or transfer it to some of the trusts that he's set up as part of giving wealth away while he is still here, so that his kids aren't stuck holding the entire bag at the end of it. So Nick, and this kind of, he's part of this conversation too, with money markets now paying 5% with little risk here. Why should you own stocks over those money markets?
Yeah, I would say that's been the biggest question all year. Nick, I get 5% on cash. Why be in stocks? Well, the simple reality is that the way that bonds work is bonds, we like to say, are just math. It's just a math equation. So if a bond pays 5%, why does it pay 5%? Well, it pays 5% because the Fed has raised interest rates to roughly 5%, which is where we're at today. So why has the Fed raised rates to 5%? Well, they've raised because inflation has got to at least be about 3, 4. Right now, the most recent print was just over 3, but it's probably hovering closer to 4 on a look back. And so because of that, if you're getting 5% on your money market, but inflation is 4%, you subtract 5 and 4, what do you end up with? 1% real return. And so if you look at the real returns on money markets, the real return on cash, you're barely breaking even after taxes. And so I would say on stocks, what we've seen, and this isn't just our research, this is Dr. Siegel going back 200 years. We've gone back about 50 or 60 years, but Dr. Siegel went back 200 years in stocks for the long run. What he said is that over 200 years, stocks on a gross basis, on a nominal basis before inflation, should compound to the tune of 8 to 10% per year. If you subtract that 3 to 4% inflation rate, which has been about the average for 200 years, your real return, your inflation adjusted return on equities is closer to 6%. And so 6% and 1% are a big difference. You cannot eat risk adjusted returns for breakfast. You can't. You have to put real returns on your table, not nominal returns. And so I think that's where people go wrong, is they don't realize that if a money market is paying 5%, which, by the way, it's a little bit deceiving. They're going to come down. They're going to go down to 4 and then 3.5 and then 3, and you'll be left with even lower yield. And by the way, as interest rates go down and money market yields go down, what are stocks going to do? Well, they're going to go up. And so my opinion is, again, once you've figured out your goals-based plan, once you've got some living expenses tied up in treasuries, just get the rest in stocks. I think long run, that is going to do just fine.
All right, and then the last one that we had is about international stocks. I know we haven't owned any for a number of years now. Some are, deeply undervalued to some extent now. And China, is at 2008 lows, basically at this point. You saw what performance has been, when we covered it on the first slide here. Has your opinion changed on it now that we're looking at how kind of undervalued those are compared to the U.S., as well as some of the political uncertainty that we have here in the U.S.?
Yeah, I'll start with the political uncertainty. No, I mean, if you're going to buy geographies based on uncertainty, the US is the most certain place on earth. And I know that sounds crazy given all the nonsense that goes on in DC and all the fighting and the government shutdowns and all the rest of it. But that's a cakewalk. That's nothing compared to what happens in some of these other places around the world politically, with these wild whipsaws between policy. And the reason I know that is because businesses have chosen the US as the place to build a company. Businesses cannot operate and thrive unless they have certainty. And so the beauty of the way our founders set us up was that we've got limited government. And I know that sounds a little crazy too. It's a little bit less limited than it was when the founders were in charge, but it still is divided. And because of that, again, every 2 years, we've got a midterm cycle. Every 4 years, we've got the presidential election. And eventually, I do think we're going to move towards a world where we'll have a smaller government. I think we're going to actually get term limits eventually. I'm very optimistic about that. And because of that, that's created a great deal of certainty for companies. They've come back to the US big time, thanks to regulation cuts, thanks to tax cuts, and all the rest of it. And I think the US is going to be the place you want to be for years to come. I think a lot of people that say, oh, the US is going to fall off the stage and we're going to be number 2 to China eventually. To me, it kind of seems like the New York Yankees. It's like, just because the Yankees are good, really good, and they win all the time, doesn't mean that next year they're going to be number 2 or 3 or 4. What goes up doesn't necessarily have to come down. And I think that's what people don't realize. You got to go back to that Matthew principle in the Bible, which is that those who have will get more, and those who do not have will have everything taken away from them. That's the principle of compounding. And so over time, what happens is that the big get bigger, the successful get more successful, and failure also compounds. And so just because the U.S. is, we've got our problems here. Yeah, we've got some issues. Yeah, I know DC's a mess and all the rest of it, doesn't mean that it's any better anywhere else. And you're seeing this with China now. I mean, China is just completely falling apart. I think they've got some serious issues. If you listen to Peter Zeihan, who can be a little bit of a doom and gloomer, a little bit of a doomsday prepper, the one area I actually agree with him on is China. He actually thinks that the Chinese people have not reproduced at a high enough rate to basically repopulate, and you need new people, you need babies to basically stimulate the economy. Because of that, China could be basically on its last generation. I think Japan could be very close to its last generation, where they could really not cease to exist, but really have a much smaller role on the global stage. You've seen this in Europe now. Broad parts of Europe do not have the replacement rates necessary to grow their economies. And I guess Elon Musk has a funny joke on that. You know, he's got like 10 kids. I don't know how many different women, but I know he's got somewhere around 10 kids. And he always says he's doing his part to help out with the birth rate. Certainly, Stenger Family Office is doing our part too, I guess. But you know, I think that's the lifeblood of an economy. Is you have to have people building families. You have to have babies being born. And without that, you will crumble eventually. And so thankfully in the US, we've still seen a steady birth rate. But the other thing that's really helped us is legal immigration. And you've seen some of the best minds come to this country. We've seen the best minds from China come here. We've seen the best minds from Japan and Europe, and our family's German. So of course, there's lots of German engineers here where we are in Naperville and the Chicago area, and the best Africans and the best Asians, and all over the place. The top minds have decided that the United States is the place they want to grow their business, to innovate. Why? Because of the rule of law and personal property rights, so that they get to decide where their assets go, not the Chinese government. And that is so important. That's why I think long run, the US is going to be the best place to build wealth.
Great. Well, we've got no further questions. And so before we close out here, I want to mention a couple of things. If you've enjoyed what you've heard today, you want to keep the conversation going, be sure to check out our YouTube page. You can find Nick's show there, the Nick Stenger Show. He's on episode 137, I believe, right, Nick? And if this rally continues through the end of the year, you're going to see him in a Santa suit to commemorate this Santa Claus rally in one of the last episodes of the year here. You can also view some of our other shows. Bullish, which Nick had mentioned earlier, is on there. We've got some of our replays of webinars, events that we do. And if you're not a fan of YouTube and you prefer Spotify or Apple Podcast, you can listen to the Nick Stenger Show and Bullish there as well. So before I let you go, I want to finish by reiterating, if you are not working with us and you'd like to start a relationship with Stenger Family Office, we start with $1,000 starter accounts. It's just $10 in fees a year, and you can reach out, visit our website, stengerfamilyoffice.com, request a complimentary starter kit, or give us a call at 630-912-8431. And we hope you have a wonderful end to the year here. And thank you again for taking the time and joining us today.